Investment accounting for private equity firms. In an era where private equity firms are increasingly dominating global capital markets, mastering investment accounting has become essential for financial accuracy and strategic decision-making. This specialized field blends traditional accounting principles with complex financial instruments, requiring professionals to navigate intricate regulatory frameworks while ensuring transparency in valuations and performance reporting. The core principles of investment accounting. At its foundation, investment accounting involves the systematic recording, classification, and valuation of investments held by entities such as private equity funds. Firms must adhere to generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS, depending on their jurisdiction and investor requirements. Accrual basis accounting plays a critical role here, ensuring revenues and expenses are recognized when incurred rather than when cash changes hands. This approach provides a clearer picture of a fund's financial health over time, aligning with long-term investment horizons typical in private equity. Proper documentation of transactions is vital. Every purchase, sale, dividend receipt, and impairment assessment requires meticulous record-keeping. Transaction dating. Accurate date tracking ensures correct periodization of gains and losses according to accounting periods. Valuation consistency. Applying uniform methods across similar assets prevents misleading comparisons and maintains audit integrity. Disclosures. Comprehensive disclosures regarding related party transactions and contingent liabilities build trust among stakeholders. Private equity-specific challenges. Private equity firms face unique challenges due to the nature of their investments in non-publicly traded companies. Unlike publicly listed stocks, these investments lack daily market prices, necessitating alternative valuation methodologies. Discounted cash flow analysis, DCF, becomes crucial in estimating fair value through projected future earnings. However, DCF models require careful calibration with assumptions about growth rates, discount factors, and exit strategies. These models often involve sensitivity analyses to account for uncertainties inherent in private company projections. Cash flow forecasting typically extends beyond conventional 5-year horizons, sometimes reaching 10 years or more. Such extended timelines demand rigorous scenario testing under various economic conditions. Moreover, the illiquid nature of these assets means they may remain undervalued during downturns, affecting both balance sheet presentation and income statement recognition. Evaluating valuation techniques. Selecting appropriate valuation techniques is pivotal for accurate investment accounting in private equity contexts. While there's no single correct method, understanding strengths and limitations of each technique enhances decision quality. Market approach. This leverages comparable public company multiples or recent transaction data from similar deals. Its advantage lies in using actual market data, but can be flawed if comparables aren't truly analogous or if markets are inefficient. Income approach primarily uses DCF analysis mentioned earlier, focusing on expected cash flows discounted at appropriate rates. It's particularly useful when reliable forecasts exist but heavily relies on subjective judgment about future performance. Cost approach estimates what would be required to recreate the asset today, less depreciation or amortization. This method is rarely used alone given its limited relevance to ongoing business operations versus replacement costs. Professionals often combine approaches to triangulate values, reducing reliance on any single potentially biased input. Sensitivity tables help visualize how variations in key variables affect final estimated values. Regulatory compliance considerations. Navigating regulatory landscapes is another cornerstone aspect of effective investment accounting practices within private equity. Different jurisdictions impose varying disclosure obligations impacting how investments appear on financial statements. For instance, SEC filings in the U.S. mandate specific formats for disclosing interests in unconsolidated subsidiaries. Similarly, European Union directives might dictate different treatment for certain types of partnerships or joint ventures. Materiality thresholds. Determining what constitutes material information influences which items get disclosed publicly versus internally reported only. Non-compliance risks include penalties ranging from fines to reputational damage affecting fundraising capabilities. Audit trails must be robust enough to withstand scrutiny from regulators and external auditors alike. Implementing automated systems helps ensure consistency while minimizing human error in compliance processes. Leveraging technology in investment accounting. Modern technology solutions have revolutionized how investment accounting functions within private equity organizations. Cloud-based platforms enable real-time collaboration among geographically dispersed teams working on shared datasets. Artificial intelligence tools assist in anomaly detection by identifying patterns indicative of potential errors or fraud. Machine learning algorithms analyze vast amounts of historical data to predict trends influencing current valuations. Blockchain implementations offer immutable records, enhancing traceability of ownership transfers and transaction histories. Digital transformation also facilitates better integration with other enterprise systems like CRM and ERP modules. Automated reconciliation features reduce manual effort spent verifying balances across ledgers and supporting documents. Data visualization dashboards provide executives instant access to KPIs relevant to portfolio performance monitoring. Robust cybersecurity measures protect sensitive client data against breaches that could compromise competitive advantages. Performance measurement frameworks measuring investment performance accurately is fundamental to assessing returns generated by private equity portfolios. Common metrics include internal rate of return, IRR, net present value, NPV, and multiple on invested capital, MOIC. Internal rate of return, IRR, calculates the annualized return assuming reinvestment of interim cash flows at IRR itself. This metric helps compare projects with differing timing profiles of cash inflows/outflows. Net present value, NPV, represents present value of all future cash flows minus initial outlay, indicating project viability. Positive NPVs suggest profitable opportunities, whereas negative ones signal caution. Multiple on invested capital, MOIC, measures total proceeds relative to original capital deployed without considering time value of money. Useful for quick assessments but doesn't reflect compounding effects properly. Combining these metrics gives a well-rounded view of investment outcomes before making further allocation decisions. Risk management integration. Integrating risk management considerations into investment accounting practices strengthens overall financial stewardship. VAR models quantify potential losses under normal market conditions, helping set realistic expectations. Stress testing simulates extreme scenarios, examining resilience of portfolios against adverse events like recessions or interest rate hikes. Scenario analysis explores impacts of various macroeconomic shifts on portfolio constituents. Diversification ratios track concentration levels across sectors/geographies, mitigating exposure to individual failures. Liquidity coverage ratios assess ability to meet short-term obligations amidst unexpected withdrawals or downgrades. Regular portfolio reviews identify emerging threats early, allowing timely adjustments to holdings. These proactive steps contribute significantly towards maintaining stable returns despite volatile environments. Case study insights, real-world applications, and examination of actual cases. Illustrates practical applications of sound investment accounting principles within private equity settings. Consider a mid-sized firm acquiring a manufacturing concern valued at $50 million via debt financing plus equity injection. Initial entries capture acquisition cost, including identifiable intangible assets, separately from goodwill. Amortization schedules outline periodic charges, reducing net book value accordingly over specified lives. Impairment tests occur annually, comparing carrying amount to recoverable amounts derived from either fair value or value in use estimates. If impaired, write-downs adjust financial statements reflecting reduced asset values transparently. Dividend distributions follow predefined terms outlined in partnership agreements governing profit-sharing mechanisms. closing entries finalize temporary accounts, preparing them for subsequent reporting cycles. Throughout this process, adherence to accounting standards remains paramount, ensuring reliability of presented figures. Emerging trends shaping future practices. Ongoing developments continue reshaping the landscape of investment accounting within private equity spheres. Sustainable investing initiatives push for enhanced ESG-related disclosures alongside traditional financial metrics. Advancements in AI promise greater automation possibilities, streamlining repetitive tasks previously done manually. Blockchain adoption increases transparency around digital asset transactions, improving audit readiness substantially. Growing emphasis placed upon climate change risks demands incorporating carbon footprint measurements into evaluation criteria. New regulations concerning greenwashing allegations compel more precise quantification of environmental benefits claimed by investees. Remote work norms post-pandemic encourage development of flexible software architectures supporting mobile accessibility needs. Globalization pressures necessitate multilingual interfaces catering diverse international user bases effectively. These evolving dynamics highlight need for continuous professional education, keeping practitioners updated on latest industry best practices. Conclusion: investment accounting serves as the backbone of successful private equity operations, ensuring fiscal discipline and informed decision-making processes. By adhering strictly to established standards coupled with innovative technological enhancements, firms position themselves competitively within dynamic markets. Continuous improvement efforts focused on refining existing procedures ultimately translate into improved outcomes benefiting investors and operating entities alike. Pursuing excellence in this domain not only meets immediate compliance mandates but also lays groundwork for sustainable growth trajectories ahead.